Hello, this is Josh Belk with the Belk on Business podcast. It's going to be real short today, recording this primarily to send out to our clientele base for our quarterly meetings. And so if you are a client and you're receiving this, there'll be a link in the message to schedule your quarterly call with us here. For everyone, I'm just going to very briefly kind of run through what we're seeing on the tax landscape and something that a lot of questions being asked, and there's a lot of information out there as far as on what's going on and what's happening. Still a great deal of unknowns. It's too early to tell as far as what exactly is going to happen outside of we know that something will happen either one way or the other. I highly doubt that we're going to see a sunset of the Tax Cut and Jobs Act provision back from 2017 and 2018. But we'll see some changes. We do have an initial kind of discussion bill that's gone out there, and by the time this gets out there, by the time this podcast gets out, this might all be just kind of old news at this point. But we do know we kind of have this July 4th date coming up that by then we should have some solid answers here within probably within the next week or two. We'll have more information, and then definitely as these bills move through and they start having kind of more deeper conversations and how they're going to ultimately pass this. Once we get into Q3, hopefully by then we schedule our next quarterly calls that we'll have more definitive answers. But let me kind of just give you a very just brief oversight of what we know as of right now. If you've ever heard me speak and even listened to my podcast in the past, you've heard me use this line that essentially the tax code is written in a way to get us as the taxpayers to act in a certain way, to deploy capital in a certain way. So if you'll notice, every time there's an administration, a lot of times there's incentives to move money and invest money in certain ways. And we're going to see this again with these latest changes. With the Tax Cut and Jobs Act, and we saw the Inflation Reduction Act and some other laws that passed during the Biden administration. And now that President Trump is back in office, we're going to see some of the more kind of infrastructure type spending being the emphasis. So what do we know as of right now? Number one, and you may have heard some of this, it's kind of this discussion on possibly raising that top tax rate for those single over $2.5 million in taxable income, and then $5 million as far as married. As of right now, it does not appear that will happen, but we don't know. But I know it's been a big discussion. I'm going to stay apolitical. If you know me pretty well, I definitely kind of have my opinion. What I'm simply going to do here is just kind of maybe just give you some observations as far as what's going on out there. And I don't, and myself, and I probably with a rare exception, I doubt there's too many people that are listening to this to kind of fully understand the ins and the outs and and I doubt anyone understands or knows the ultimate implications of what this would have, any of these elements. But first of all, that discussion's been a lot of talk on it in regards to whether or not this top rate is going to be increased. As of right now, it does not appear that it will happen, but once again, when you get into the negotiations, it's possible that it will. Number two, increasing the child tax credit from $2,000 to $2,500. If the Tax Cut and Jobs Act provision would have essentially expired this year, that would have gone back down to the pre-2018 rates. So, but that is a slight increase in the child tax credit for those with children that will qualify. Number three, increasing a threshold for state tax exposure from $13.9 million to $15 million. This is kind of a thing that doesn't affect a whole lot of people, but just something to be aware of. Number four, a certain provision of the Tax Cuts and Jobs Act to become permanent. And part of this would be this QBI deduction. So if the Tax Cut and Jobs Act provision did fully expire, and if they do fully expire, that QBI deduction is going to go away. And so for many of our clients, I would say for most of our clients, to qualify for the QBI deduction in some form or fashion. And they're in an industry that permits it, and their income threshold would permit it as well. And so, but that is going to, if that the goal as of right now is to get that aspect of it to be a kind of a permanent provision in the tax code, and then the possibility as far as whether that stays at 20% or whether they might increase it up to 22%, we'll have to wait and see. Number five, nothing currently on the increase of the SALT deduction, so the state and local income tax. So if you itemize your state and local income taxes would be capped at $10,000 as far as the deduction. This impacts, I would say, a great deal of our clients. I know it heavily impacts me, and I don't live in a high income tax state, you would think. Now here in Indiana, people think it's a low income tax state. We have this, tick over 3%. But then once you add county tax, and we're basically not a whole lot better than Illinois. So depending on where you're at, this is going to be a huge impact. And of course, this has been one of those conversations I think both sides of the aisle have had some issues with in regards to the SALT deduction. Now, if you own an entity and you're in a state that allows for your entity to be taxed, it's called PT tax, all different things in different places. But if you allow for your entity to be taxed at the entity level, that might be a good tax saving strategy. So this will be something that we'll be talking about with our clients a little bit more during this year. Especially, we're seeing more and more states allow for this to happen, including Indiana, and it's something that I'll be looking into even for myself this year. So, but as of right now, nothing currently in regards to increasing it. I will be actually, personally, just my opinion here, I would be surprised if something isn't done there, some sort of maybe an inflation-based increase or something to that effect going forward. But we'll have to see what happens. During the campaign season, we heard a lot about no tax on tips, no tax on overtime, and then no tax on Social Security benefits for retirees. That is supposed to be part of this provision. What that's going to look like, I have no idea. As a tax professional, my biggest concern. Okay, fine, this is all good. What sort of nightmares is this going to create for our clients who have employees, and then for those of us who have to try to advise clients and complete the forms, and kind of going back to the nightmare of the pandemic when we had all these provisions and the changes and the whole nine yards, and we may have some of that again as it relates to these particular matters. The no taxation on Social Security, that's not a big deal. The other two, if you have employees, it's going to be interesting to see what that ends up looking like. Number 7 here, tax on foundations, ranging anywhere from 1.4% to 5%, depending on revenue levels. So that's going to be something. If you do have a foundation, that's something that you may definitely want to follow what happens there. Number 8, and this is the number 8, number 9. I think are the two biggest areas that we've heard from our clients. Number 8 a lot less than number 9, but number 8 here, 100% deduction of domestic research and experimentation or research and development cost. And so there was a provision put in to where those R&D costs had to be amortized over 5 years. It could not be fully expensed. And this went into place in 2022. And then, and so essentially what's being talked about there is that 100%, allowing for the 100% deduction of those particular costs, those qualified costs. And actually, this would be the one provision that would be retroactive back to 2022. And so, and of course, you have to, the R&D credit, things of that nature. It's all going to be part of this. But essentially, there'd be an opportunity if you have the R&D deduction and you're amortizing it, that to be able to go back and essentially be able to fully deduct that in the year that the funds were spent. So something to keep an eye on. Number 9, and this is the biggest one in regards to the bonus depreciation for such things as machinery, equipment, and then I think most importantly for many of our clients, the qualified improvement property, the Section 1250 property. So for our clients that invest in real estate, for the improvement property cost to also be fully depreciated. So we've seen kind of this drop down in depreciation from 100% 80 to 60 and 40 in 2025. And so what this would do is actually would make it 100%. And this, I believe, the initial discussion is to go back to January 20th of this year to allow for that full bonus depreciation. So and of course, there's a lot of other things going on. Most of those are kind of outside the scope of our clientele, and for many of you who are listening. And so I'm not going to get into those other areas. I just kind of talk on some of these areas that impact our clients the most. And so just kind of be following this. I will, and it's been a long time since I put one of these out. What I'll do, I'll be putting out podcasts. I do have a few lined up. And then once we do know something more, I'll record something a little bit more specific for our clientele base and kind of go into a little bit more detail so we can plan accordingly as we move into Q3 and ultimately into Q4. So hopefully it may give you a little bit of information here. Please, if you're one of our clients, you'd like to schedule a call, please go ahead and do so. The link will be in the email sent to you. Please go ahead and do so. And then we'll go ahead and hop on, have a conversation. Hopefully by the time we have our conversation, we'll know a little bit more. Once again, this is Josh Belk with Belk on Business Podcast. Have a wonderful day.